Hey guys, welcome. Glad to have Josh Young here in between the Christmas and New Year period. He is the founder of the fund Bison. How do we call it? Bison hedge fund?
Bison interests.
Bison interest. Sorry, I missed the interest bit. And I didn't want to misintroduce you there. Welcome, first of all, Josh. Glad to have you.
Thanks for having me on.
As we head into 2023, and oil had a great rebound last 18 months, hasn't it? Particularly, and of course, natural gas energies was almost the story of 2022 to many degrees. There was an element of the dollar coming in as well. But just curious, what kind of environment do you see us going into or for energies for 2023, Josh?
Yeah, it's a great question. It's funny because you said that 2022, the story was energy, and that's it's been a year where energy has materially outperformed the market. But from my perspective, I actually think 2021 was really the year for energy where finally oil and gas materially performed well along with the market. And that was actually the first year, I think, in many years where there was a really strong year for oil and gas and a really strong year for the market. And that, I think, set us up for this year where we've had a great run in energy with a down market. And I think it sets us up well. It's hard to tell exactly the timing on this, but there's this multi-year reversion process where when you underinvest for many years, you need to overinvest for many years to make up for it. And the only way you get overinvestment is through high price. And so it's really hard to tell, like, let's say day to day or even month to month, sort of what the price is going to be. But year to year, you need really high prices, higher than I think people are used to comfortably talking about, in order to induce investment in something that's uncomfortable and has been very unprofitable for many years.
You're absolutely right to pull me up on the 2021. In fact, that was when we reversed long as well. The high was March 22. In fact, since then, we've actually been sideways and now down quite consistently. It's more the headlines I was referring to. They always seem to lag being early, as someone who's had an interesting history with oil and energies as well. Gas, oil, which one's going to be the stronger? Do you have a preference? How are you biasing? Or they're both good?
Yeah, it's a good question. So gas is more local. So there's sort of a U.S. and North American natural gas market, which has been much weaker than the European and Asian markets. Those have been falling recently into a warm winter so far. Frankly, in the U.S. as well, natural gas has been falling also. Just, again, winter has been a little warmer and supply has been a little higher. I'm biased pretty heavily towards oil. I think oil as an underinvestment theme makes a lot more sense. I think European and Asian gas actually could, I don't know exactly where they bottom, but I think they could rebound substantially in 2023. But I think there is limited upside for those. Whereas for oil, we're still at this point, we need a lot more investment. So for natural gas, there's enough investment in producing and you just need to get it transported and delivered. For oil, you really need to sort of start the process all over again and start exploring and delineating and developing new fields. And that takes many years. And it takes, to get the oil that we need, it probably is going to take over $1 trillion. And so that money just isn't there for oil, for investment. And so you just need high enough prices that people hold their noses and do it anyway.
That's the thing. It's the whole watermelon communism, as I'm sometimes referred to it, rather unfriendly. But the green agenda that seems to have almost made it unpopular to and very difficult, banks and scores and all of that. Incidentally, I'll just pivot you to a chart where we've reverted a little bit more conservative on gas. And like you, we have a bias for oil, although I don't think it's going to have the year that it had in 21 or the first part of 22. I have concerns about the interest rate environments, but I'm not sure if you can see this. We've got a macro head and shoulders over here on natural gas that has triggered and has been throwing down. We've been talking in our community about it. And gas seems to be a little bit of a problem, I think. I think it's going to have a tougher time. We have had head and shoulders before here already, the smaller one. We sometimes call that a monarch and nestle, but the smaller one in there, and that's already come down and met its target there. And then we're in a much bigger structure. It could suggest numbers sub three again. Now, you already mentioned quite correctly that it's two different worlds. Europe obviously was caught short badly, and they had major run-ups. But I have a concern that there's going to be a demand-killing event coming, potentially with the interest rate hikes. Invariably, that's we saw with the events of March 2020, the effect that had obviously on the oils. What's your view on the macroeconomics that could affect energies? Is this feasible? Sub three on the gas?
Yeah, sure. I mean, anything can happen to some extent. Like you said, March of 2020 showed us that there's no hard and fast rules for these commodities in the very short term. I think what I would look at for U.S. natural gas in particular is that even though there are maybe technical arguments for the price to fall, and it could fall quite substantially over a short period, inventories are still quite low. And so what that means is that in a low inventory environment, there's going to be a bias to the upside from a price perspective. And so even if price is falling right now, yeah, the price is falling, right? You should believe your eyes, the price is falling, but that doesn't mean that the price will necessarily fall tomorrow. And it looks like in particular, and this is sort of like shorter term that I like to focus on, but in particular, there have been a series of warm weather forecasts looking out, let's say 14 to 21 days. And those have been progressively warmer, but weather is mean reverting, sort of similar to commodity investment. And so there's a real good chance, and some of the better meteorologists that I follow, I mean, they've been talking about this. And again, I'm not a meteorologist, and I really don't like to take short-term views, except I do think that there's a decent chance that here, the really smart meteorologists might be right. And if they're right, you could see that flip, that trend that you're identifying flip really hard. And, I would just recommend caution in any direction, especially for winter natural gas. But again, that's sort of more from my perspective, a little bit shorter term. I think there is a real risk, like you're saying, in terms of economic sort of demand shock. I just don't think that we see a demand shock anywhere close to what we saw, particularly for oil in 2020. I think it makes more sense to look at past recessions rather than past sort of forced shutdowns. And I think it makes sense to look at parallel recessions. So not necessarily 2008, which was sort of the last big one everyone thinks of, but to go back a little further, look at the 80s and 70s and 40s and just sort of understand the context. And I think that helps a little more than just reverting to the last one or the last two.
Oh, yes. Yeah, no, absolutely. Recency bias. I don't think we do small recessions anymore, given the amount of debt we've piled up. But that's still said, it's never going to, you always fight the war, the next war with the previous war's weapons, and that's usually inappropriate. The most recent one being the COVID events, which were quite unique. Yeah, that's fascinating. And in fact, I agree with you, even though you could have this, I assess that this natural gas could make that target, but it would be, as I say, probably quite a unique environment, and it doesn't fix the fact that there's been underinvestment in energy, and it's the kind of thing that snaps back quite hard once done, because demand can be cut for only so long, and then people can stop doing things for a while, but then eventually the natural return rate, much like you were saying on weather. How many times have we had a mild start to a winter only to have really late cold cracks coming on in April, March, etc. So, yeah, makes sense to me. So, Brent and WTI, do you tend to look at these differently on account of different demand fundamentals? Do you split them out, or do you just generally think there's that pretty consistent premium, and you don't tend to specifically different analysis for it? It's more refiners type detail. How do you handle the differences in the two primary oil contracts?
That's a great question. So I think it depends on the supply and demand environment. And there are periods of time where it matters a lot, and there's periods of time where it doesn't matter very much at all. And so I think right now, so one of the big contributors is the cost for shipping, which is one of the drivers, obviously, of that spread between WTI and Brent. In addition to sort of refiner preferences, it's also a question of, for refiners in, let's say, Asia really prefer, one grade, and then, in Europe, they would prefer a different grade. It kind of doesn't matter if it only costs you 50 cents a barrel to transport it from one place to another. It matters a lot if it costs you $5 a barrel to transport it from one place to another, or if you just can't book a ship. And so, in the environment we're in right now with very strong current tanker prices, which I'm actually sort of a little contrarian bearish on, just because everyone I know, everyone who follows that space is very bullish on tankers. I mean, you can't find any bears. Generally, historically, that's been the prelude, especially with something like shipping, where these things, they trade to NAV or 2 times NAV and then they collapse. From an equity perspective, they seem very uninteresting just because everyone loves them. And so that leads into the WTI versus Brent spread, where, I think it's really hard to tell right now because of that sort of weird dynamic in the tankers and that really high price for tankers. I think we are set up more likely than not for lower shipping rates. And if we have lower shipping rates, let's say a year from now, than we have right now, there's a good chance that we have a tight spread between WTI and Brent. So I'm right now more focused on sort of just a holistic view on oil demand and supply rather than on sort of specifics around Brent versus WTI. The one exception is heavy versus light, and sort of sweet versus sour, which is less of a WTI versus Brent question. And there is an issue right now with heavy, where heavy's been a little oversupplied, and especially on the sour side. And it looks like that's, as the SPR releases come down, looks like that issue should resolve to some extent. And that sort of, the WCS or Maya versus WTI spread, that should come in here pretty substantially over the next number of months.
Yes, just getting into those topics, I can't help but think you're going to be the perfect guy to bring everyone up a standard notch on energies. Can you explain to people the sulfur contents in tar and what makes for heavy and light, so that everybody gets the Bluffer's Guide level?
The two sort of big criteria, and there's a lot of complexity, and this is very like a gross simplification, but it's worth understanding. So the two sort of big criteria from my perspective, and it seems like from refiners' perspectives on oil, are one, the gravity, which is sort of how dense it is, how easily it flows, and that also affects what sort of products you can turn your crude oil into. Not all crude oil gets refined into the same slate of output products. So from heavy, I think you get a little bit more diesel and jet fuel. From light, it's a little easier to get more natural gas liquids and other sort of lower price than the current environment products that are more useful for plastics. So that's sort of the heavy to light. And we're coming from a period where actually heavy was very in demand and light was a little oversupplied because of the end products, to a period where there's been a little extra supply of heavy, partly because there was sour, sort of oddly enough, coming out, so high sulfur content oil coming out of the SPR, and partly just because of the mix of where heavy was coming from and sort of where supplies have been disrupted from a Russia and other perspective. And so heavy again versus light does it look more like asphalt? Like is it basically like rock hard, or really slow and thick, or is it thin, almost gaseous, sort of on the extreme, and condensate where it looks like soda or something, where it's bubbly? So that's one aspect. And the other aspect is, does it have a high sulfur content or low to no sulfur content? And sulfur matters partly for the refining process and partly for the complexity of refiner that you need in order to process the oil. And there's a weird setup in the Gulf of Mexico area for refining, where many of the refiners were built with high complexity because they were built to process oil from Venezuela and other similar sources that's very heavy and very high sulfur and complex. And so complex refineries are not built for light, sweet crude. They're built for sort of this more complicated, higher sulfur crude. And so there is this preference among those refiners with the higher complexity to get heavy sour oil. And so when they're not getting that, they're going to pay a lower price, and the value of the products that they refine out of it are a little lower. So that's sort of those are sort of the two big sort of physical components that affect price based on refiner setup as well as on the outputs from those particular qualities.
That's fascinating because I know also that many of the big shipping companies have been, I think there's a law now they can't use the bottom of the barrel, the heavy distillates. I think that might be, where does that tie in with RBOB and the heavy distillates? How does that affect the demand fundamentals given the green environment and these massive ships? I think someone once said that 9 of the stinkiest ships were actually creating more carbon than most of the vehicles in the Europe. 9 of the heaviest tar burners. How does that tie in? How does that change in demand if they've been having to pivot away? When does that come in force? My memory's fading a little bit. Can you update us on that aspect?
Sure. So I think that was more of a story pre-COVID, so sort of 2019 going into IMO 2020. Honestly, it's not something that I focused on recently just because some of those ships put in scrubbers, and then there's been some additional mechanisms that refiners and others have used to deal with some of that ultra heavy, essentially like bunker fuel, the very sort of thick, dirty byproduct from refining. And so it's not an area, honestly, that I focused on recently.
Okay.
It hasn't been but it is worth highlighting. So that was a big issue. And I think one of the big things with oil is you don't really, in my opinion, want to focus on where everyone's focused. So right now people say, oh, there's a tanker shortage and tanker stocks are super high and day rates are super high. To me, that makes it very uninteresting. And again, I don't really short stocks and I'm really focused on equities, but that just lets me know, okay, that's good. And probably those rates come down and there's some big disappointment and I'll just like file that in the too complicated, too expensive, not for me. And so similarly, that IMO 2020, there was a big story around it and a lot of excitement, and it kind of didn't matter because COVID happened and there were shutdowns or whatever.
Oh, well, yeah.
Generally,
I was curious if there was a new demand now on cleaner fuels now that they weren't to burn the heavier stuff, if that makes any sense, and if that was very material, but it seems not, and it's not your area. Just as a shared anecdote, not as a question, just a comment. I'm in Cyprus and I have contacts here that are in shipping, run out of Switzerland, but here, and they got into, they were just saying very closely to what you do. They tend to chase the container that is the most out of favor on the basis that it's bottoming. And he chased into oil post-COVID, the oil tankers. And he's now gone from in and around 12,000, 15,000 a day. He's actually got as much as 140 grand a day for his ships, and he had 3 or 4 ships that he was moving. So, that truly oil tanker rates have gone from being, barely able to survive at any level. And I think costs about 7 to 8 or 9,000 a day for the captain and crew and various other aspects. So that's turned into a cash hemorrhaging business at the moment. And he's got some cash flow to invest. And so I was thinking, well, are you going to double up and get more? And he's got, no, I'm going to go containers. I'm not piling into oil again from here. So containers have dropped a little bit, and oil has been more the prodigal son, the return of the prodigal son. So I think his mentality reflects very much yours, that prices fixes these things. And those are super normal profits, and they don't tend to kick around forever. Yeah. So, yeah.
Absolutely.
Interesting anecdote. So being an equities guy, we've spoken a lot around that. We've spoken about the prospects for energies generally and a little bit about different categories. Where's your favorite picks coming? What kind of sector are they? Are they exploration? Are they the big majors? What do you like inside of that when you're mining inside the sector?
Sure. So when you look at, and you're a chart guy, so I think you'll or a technical analyst, so I think you'll appreciate this. There's been a variance, abnormal variance in returns for large caps and oil majors versus oil services companies and small cap producers. And you can look at it, if you look at, let's say, the 10-year chart for oil versus XLE, which is sort of the majors and integrateds, and you compare that to if you add PSCE, which is an ETF of small caps. I'm not recommending it. There's some real sort of stinkers in there too, but it's just a good indicator. and OIH, Oilfield Services Index, again, similar idea, good companies, bad companies, it's just good as an indicator. And you look at it, I think we looked at this from 2014, but I think even from 2012, you look at the small caps, they're down with like 70 or 80%. The services are down like 70%, and the large caps are up or flat, and along with oil. And so, and again, like those numbers are going to be off slightly because I looked at it from 2014 and not 2012, but just sort of directionally, when you look at it, I'm interested, similar to your friend who crushed it in oil tankers. I like the stuff everyone isn't looking at and hates because, in the short run, it's a voting machine. In the long run, it's a weighing machine. And, with my background and having done this probably for too long, it's possible to sift through this set of companies that have sort of been not bid up yet by the market. And yeah, like we've done well the last few years, but they're still on a relative basis, large undervaluations in these areas where the general area has materially underperformed. So I like to fish where there's shallow water, and the shallow water is with lots of fish that I can see. The shallow water with lots of fish right now is small cap producers and services.
Yes, it's interesting because since our big call that we made, we'd also shorted tallow oil, and we'd shorted Plains All American. And I've gone and looked at them, and they've just simply not retained, given the amount that this is the point you're making, that there's been as much as oil has recovered, there's been very much an apartheid of response. As the big caps have reflated immensely, and some of these other players and some of those around the oil space haven't. Plains All American still very, very low. We called that one from around 27 down to 3, and I think it's about 10 or 12 now. It's not anywhere near where it was pre. Whilst the majors in many instances are right back up there. If you take a what's our Rockefeller friends, Exxon, where they should have done very, very well. I'm imagining we can bring them up as well. They seem to have recovered phenomenally. So are you looking for value at the moment on the medium size and the services sector then around that?
So actually the medium-sized companies are complicated because most of them have traded roughly in line with the large caps and with the majors. I'm actually looking sort of on the smaller side where there's been sort of the largest lag in performance. There's the biggest discounts from a pure valuation perspective. So, I like replacement cost. I like, which is a complicated measure. I like free cash flow yields, making sure that the balance sheets are healthy and that the assets are quality and are able to generate a lot of cash. So not just corporate free cash flow, but asset level ability to generate cash in a reasonable price environment. And I mean, it's pretty amazing when you look at the disparity, that sort of high level disparity in return, that translates. I mean, we've been buying stocks at sub 2 times EBITDA with, in some cases, 30 to 40% free cash flow yields at strip pricing, right? Not $100 oil, 150 at strip. These things, and to put that in context, some of the larger caps are at, let's say, 6 or 7 times EBITDA, and let's say an 8 or 10% free cash flow yield. And so, I mean, there's a gulf there, and there's transactions that indicate that some of these small caps could get bought out, and there have been very public.
It sounds like an acquisition market that's due to break out. Surely there should be, because it's a great way for instant earnings for majors to buy such low cost earnings, really, isn't it?
Yeah, it's remarkable. And so there's a slide, actually, a energy private equity fund. They had me come to their annual meeting, and they put this together. So we're going to use it on our next macro presentation or whatever. But they show the acquisitions by large cap E&Ps buying small caps, and they show and it's mostly been private companies so far that have been bought. And the private companies are getting bought for around 3 times EBITDA, and the big companies trade at, let's say, 5 to 7 times. And those stocks go up on the announcements. So when you go up on an announcement on a multi-day basis after you announce an acquisition, you go do more deals. The interesting thing is that the private companies that have been willing to sell at, let's say, 3 times EBITDA, they're running out. There's only so many private, meaningful sized companies available for these producers to buy. As they run out of the private ones, they're going to have to start going to the public ones. Well, if you're a 2 times EBITDA public company and you're half debt and half equity, if you get bought out at 3 times EBITDA, that's 100% return. And that's just in line with recent transactions. As the market heats up, I think there's a reasonable expectation that you get this sort of arbitraged higher and you end up with transactions going to, I mean, it's just too much return available for buyouts. So I think you end up with sort of closer to 4 times EBITDA transactions, which is the low end of the long run transaction history for oil and gas at mid-cycle prices. So I think it's a really interesting setup. Owning them on their own is great, but like I think we're getting close to the point where we see many transactions and just a forced re-rate of the whole sector on the small cap side, which coincidentally would lead to that line that you're looking at on PSE bumping way back up. Maybe it doesn't fully catch up with XLE, but you got a double or triple in there just if you end up with a buyout boom similar to past cycles.
What's that code again? PSE, is it?
PSCE. And again, I'm really not recommending this. It's not just like a cute.
Oh no,
like,
you should qualify it. We fully understand. This is more bad for benchmarking, and you need to be a picker inside of that. But it's just truly interesting because I'm going to put a marker on that, and I thank you for sharing that with us because I'll put that in the chart watch and have a wee peek. So, but you do need to know your companies, and you need to be a good stock picker for this because you've got to read a balance sheet, haven't you? This is a proper fundamental exercise now.
Yeah, balance sheet, cash flow, and it matters what the companies are going to look like in a year or two if they execute on their plans, and it matters what the odds are of them actually executing on their plans. And so my preference is to buy companies where they're already doing it. They're already achieving what they're saying they're going to achieve. And the market either doesn't believe them because historically they didn't, even though now they are. And again, I don't like to bet on that they will in the future, but if they are right now and they have been for at least a little while and there's evidence that shows that they'll continue, I'm happy to buy something that everyone hates. Frankly, I think I'm developing a certain reputation for dumpster diving like this, but the important thing for me is that it's already inflected as a business. When it's already changed, it gets a lot safer, and then I can buy it for the same price or sometimes even cheaper than things that are inflecting down or that are just continuing to underperform. And so there's really, I mean, with as blown out of a chart like this, with as blown out of a sector like this, a subsector, no one's talking about small cap oil and gas. I mean, it's really, it's sort of slim pickings. It's like there's almost no one doing it. There's a lot of stuff available. It's really, there's some competition, easy pickings. So yeah.
I almost think just for surviving the March 2020 events for the 2 years, providing you're not so hopelessly indebted that there's no way out for surviving it, you almost deserve a medal and you're merit worthy of at least a look, given what happened in that environment and the leagues and the lags and how long it ran on for, because that has to be one of the most exceptional energy deficits in demand that has ever been brought about globally. I mean, there just was no place to hide, truly. And it is the survival of the fittest. So yeah, it's certainly a point of interest and inspiring. Do you have a pick that you're happy to share at this point that you quite like that we could look at technically with you?
Sure. But before we do that, just one thing on your comment, and it ties back to what may happen with oil over this next year. So we're in the process of one of the largest oil consumers in the world reopening. So it's the last big one to reopen from COVID, and it's happening right now. And so I think it's important to remember just how extraordinary it was for entire countries to shut down for periods of time, how out of this world and impossible to even think of this was even in February of 2020, right? No one thought this was a good idea. No one thought it could even happen. Yeah. And you may have in like late February, but like there was a period of human history where up until very recently, this was not even conceivable. We're now reverting because it's apparent that this doesn't work to manage a virus as infectious as this. And so as China reopens, which there's evidence that they're already reopening, their public statements are different, the daily flights are inflecting up, they're relaxing and undoing most, or if not all, of their COVID rules. As that happens, I think we're set up for another reopening wave of positive oil demand. And so that matters a lot because that's different from a sort of the global narrative. That's different from almost every sell side analyst. That's different from the Wall Street Journal that published an article last week that was nonsensical. They said there would be no incremental demand from China reopening. And it's like, hey, I read articles like that in October of 2020, and then I went and bought more oil and gas stocks, and that was wonderful. So just to be clear, I think there is another wave up of demand, and I don't think that's priced in, and I don't think people are expecting it. So for oil, I'm quite bullish. I don't know exactly when that kicks in. Is it January? Is it February? How many more people get sick in between now and when China's sort of fully reopened? But there is this wedge. It looks like it should be about 3 million barrels a day of demand. There is not the supply available for that. And I think we're potentially set up, absent a huge economic disaster, in the short run, we're set up for oil going crazy. And frankly, oil going crazy could be a catalyst for the sort of economic disaster you were alluding to from higher interest rates. And that happened over multiple recessions in the past. So it is something to watch for. And I think we are set up. There's a risk to the upside, potentially to the extreme upside for oil from this China reopening. And again, that's a very non-consensus view. And it's just based on flights, based on traffic and congestion data, essentially going from very low to higher, as well as looking at every other country and what happened when they went from being locked down to being reopened.
Yeah. No, I take that one on board as well. I think that's a very significant economic space that can't have been running anywhere close to capacity with what they were doing until now. That should almost want to come back with a vengeance and we could see hyperactivity there. So that's a great point. So you were about to let us give us an example, small cap.
Yeah, let's do it. So Journey Energy, this is one I've talked about publicly before. I own the stock. I've owned it for a while, but I sized this up significantly in late 2020, early 21.
And that analyst, Joy?
Yeah, that's right.
Gotcha. I'll put him up and then we'll bring the chart up for you to talk over.
It's probably worth sharing just the 30-second super high level. So the two things I like most about this, well, three. One, the valuation is very low. Two, the decline rate on their production is very low. So as oilfield services costs rise, as there's oilfield inflation and general inflation, they're insulated to a large extent because they don't need to reinvest nearly as much as the average producer in order to sustain their production. So their asset is it's set up as a free cash flow king sort of asset. And from a valuation perspective, in 2014, shortly before the oil price crash, at the peak of a long oil price upcycle, assets like that would transact for over $200,000 per barrel of oil produced per day. And they've been buying additional assets recently of the same sort for around $25,000 per barrel of oil produced per day. So they're buying things that 10 years ago were worth 10 times what they're paying right now. And that's a really interesting setup.
Yeah, and technically they've had a good stretchy run that they got a bit of a pushback there, but then winding up interestingly here. And if we have a look at their bigger history, and that's a weekly chart, let's go maybe a fortnight, they've come down from far giddier heights at some point. They do have a earnings report coming out not too distant future as well, if I saw that correctly. Let's just go back on that daily. I think there's one mid-Jan.
It's possible. Historically, they've come out with their annual report sort of in the March timeframe, but they'll probably put out an update that's sort of like a pre disclosure ahead of that.
Gotcha.
Yeah, January sounds.
16th March, actually. Apologies, misspoke. So you were quite right. Q1 mid-March. Beware the Ides of March. There you go. 14th of March, which will be for the year ending that we're in currently. So that makes sense. We've not got any earnings expectations just yet. So that's still some way off. Yeah, looks interesting. There's a squeeze happening. We've had an expansion of volatility on that. Had a good run up. So that would have been the warning that you're coming out of a bit of a broadening structure when you broke there, but didn't continue to fall, held a level, and now higher highs, higher lows, and just slightly lower highs. So there's a bit of a coiling and going on there. There's a impulsive move to come there, I would imagine, at some point Josh. Hopefully to the upside for you. And yeah, doesn't
Let me share one more thing about them that makes them really interesting. So
yes.
they're an E&P company, right? And they're a small cap, and they're in this universe where small caps trade at, let's say, 1.5 to 3 times EBITDA, depending on their situation and quality of assets. They also have a power generation business that they've been growing internally. And there's a value investment framework called Good Co, Bad Co, where you'll have a really valuable business embedded in a larger, typically less valuable business. Power generation of the sort they're doing, which is integrated with their natural gas producing assets. They produce a mix of oil and natural gas. Integrated power production generally gets valued in this sort of 8 to 12 times EBITDA valuation range. And again, small cap producers are trading for, let's say, around 2 to 3 times EBITDA. So they have this business that's embedded in them, and it's very small right now, but it's been growing by about 100% or more a year since they launched it a few years ago. And so it's going from immaterial to very material. The easy heuristic is the power generation's worth about $3 million per megawatt that's installed and producing. And they're at about 14 megawatts right now, and they're guiding to adding about 14 megawatts next year. So for a $300 million company, they're spending, let's say, $10 million in order to accomplish it. So it's sort of a 3 to 4x return on investment for them in terms of what it costs them to do versus the installed value. But more importantly, when you look at that uplift relative to their market cap, as they continue to install these things on their production, and they have a huge runway. I mean, people looked at addressable market for tech companies, but it's actually physical. There's a need for the power in Alberta, which is where they are, and they have the gas to be able to do it, and they're able to get these permits over time to install them, and they're showing that they can actually competently install them and ramp them up. There's room for them to increase their power generation substantially, and as that happens, they can end up with a business that's worth more than their whole company, but it only represents a small fraction of the cash flow of the business. So you end up with something where you can end up winning if E&P companies do nothing, and I think they're doing well on their main business, but if they did nothing and they just stayed flat, which they're not, and they're generating a lot of free cash flow, and they'll pay off debt and then buy back stock and what have you. Even if they did nothing, they could potentially end up doubling just from their power business over the next couple of years. So it sort of has this, like, I think you're noticing on the chart, there's sort of this embedded potential, but they have in their business this embedded potential. And so I like these sorts of things where heads I win and tails I don't lose too much. And this is a sort of setup like that fundamentally, where that sort of embedded business, that's there for me. If oil prices fall, that's there for me. If things are disappointing on the upstream side. And frankly, it's just this sort of free, wonderful thing that's growing to become a really meaningful economic portion of their business.
Sounds like a nice separate lottery ticket that comes attached to the everyday grassroots business that seems to already be showing a great deal of promise, and possibly if it continued to grow outlandishly quick, could be a spin-off, and you could end up with a second equity or a substantial payout if it was sold. Very interesting. Yeah, good, great. That's Joy in Alberta. It's around and listed on the Toronto Stock Exchange, I'm assuming.
Yeah, that's right. It's on the TSX. It went public in 2014. That explains that fall off in the chart right after it IPO'd. And talk about bad timing on an IPO, but very impressively, I think they were able to turn things around and not just close up shop after that oil price crash in 2014. And they survived the 2020 crash.
I was about to say, that's two pretty ugly macroeconomic events that, to be fair, are beyond any oil producer's control. The listing 14 was a huge spill. I remember that. And funny enough, we had a Russia-Ukraine escalation around 2014 as well. Funny how those things go hand in hand. Then they sort of formed a floor. You could see it over here. And then they got the double whammy. They'd formed a kind of floor in and around the dollar and what's that? The $3 mark. They were sitting over there. And then, of course, they had the indignity of the March 2020 events. And actually, they didn't go too well. It depends. What's that absolute low? Absolute
no, it was real low. They got close.
Yeah, it's 6 cents. Wow, 6 cents.
Yeah.
that was hanging on. They wouldn't have been enjoying going to work at that time. But then since then, steady up, and then actually the recovery post the COVID events has taken them beyond the floor of pre-COVID, which technically you would say is also a positive sign. So, I mean, that was...
I'm excited. I'm excited for them to. So if you look, they're back over their 2015 levels, and they're just getting close to sort of clearing that 2015 bounce after the post IPO crash. And I think over time there's a good shot for these guys to clear their IPO levels. And I think at that point, I'm really more of a fundamental guy, but you look at charts like this, if they can get there, right? And again, I think the fundamentals are very solid. They're set up to pay up almost all of their debt over this next year from free cash flow. They're going to grow a little while they're doing it, and they're rapidly growing their power business. I think they're set up to be able to get to that IPO level. And I think once they clear that, it's pretty exciting from a sort of long-term.
So debt-free in a year's time out of organic free cash flow.
That's their guidance, yeah.
That's pretty strong. I mean, in an increasing interest rate environment, that means a lot, albeit there might be some shocks to the downside. That's a classic little inverted HVF that you had over there that we could draw. And we normally get funnels that come out of that. And when you retrace above those, we see that as a bullish event, that you've negated that. You've now played out the downside and you're now reclaiming previously lost territory. So from an HVF method point of view, you've jumped above this level is very significant. That was an interesting draw. There are others that you're okay with giving us a look in on?
Sure. I'm not sure what you're going to think about this one technically, but Sandridge Energy, that's another one that I own.
Energy, yep, that's NY, New York, listed. Let's have a look. I'm assuming still, actually, it's not terrible. It's had a full base out again, also out of the March 2020 events. I'll log scale this if you don't mind that, just to see it more in proportion. That was a beautiful setup for the recovery, by the way. If I'd seen that technically, that would have been a beautiful first setups in a new trend. Always generally give overperformance. So this is our typical technical rules. And then when you come out of a broadening structure like that, a trumpet, we call it, then you're probably going to go sideways, maybe rest a bit. So you might come off a bit before you go up, or sideways. But nonetheless, there was a spectacular recovery there out of that. Trading $16.36 at the moment, and was also sub $1 at the extremities of the crisis, 70 cents. That was a great buy. At 70 cents. Imagine you got it at 70 cents through to 16, you'd be about 20 plus X to the good. So tell us the story that you like on it, Josh.
Sure. So it's they're a post-bankruptcy equity. So people hate it because in many cases they didn't change the name, which is unusual. So in many cases, people have owned this, who have been in the market historically, and they owned it in the prior structure. I mean, this was a $20 billion company at its peak 10 years ago. And, here it is the market cap 600 million or so. In the time since they emerged, they paid off all their debt and they have repositioned their asset base. It took a few CEOs. It took Carl Icahn getting involved. He's now their largest shareholder and he's not on the board, but the board is entirely people who he nominated and got on either during the proxy battle or after. And right now they're sitting on about $6 a share in net cash that they've generated from the business. And again, no debt and roughly $6 a share of cash. And they've been growing their cash balance by about 50 cents a share a quarter. And there have been quarters where it was even more than that, but at current prices, that's sort of the right number. And now they're starting to grow their oil production, which was a small percentage. They're mostly a natural gas and natural gas liquids producer, but they're now rapidly growing their oil production by coming in and redeveloping some of these old fields that the company got before they went bankrupt. So if they can just get their production up instead of down, which they're in the process of doing, while also continuing to add cash to their balance sheet, there's the potential for it to, flip significantly from a value perspective because it goes from a melting iceberg to a normal growth company. And then they're sitting on all this cash. And my preference is that they buy back stock and then pay a dividend. But if they were to just flip to paying a dividend, they could pay a 50 cent a share dividend a quarter from their current free cash while growing, while sitting on a giant cash balance of $6 a share of cash. So they have a real sort of potential flip to switch. And I think one of the things the market is sort of sussing out is that they haven't been willing yet to return that cash. It's a very odd thing, right? Because Carl Icahn is all about, hey, it's not the company's cash, it's the shareholders' cash. And so I've been meaning to like send him a letter. We'll see. Maybe I'll do it, maybe not. But it's a little scary because, he's quite vicious. But I think eventually they return that cash or they just get bought out. And sitting on a growing cash pile is a great way to not have your stock go back down to 70 cents. So I think it's sort of a very defensive on the downside, and it has a lot of potential as they grow their cash position and grow their production. So that's the fundamental story. I think, I don't know what happens in the near term. It's sort of less clean than Journey, but it also is, they're sitting on all this cash. It really seems hard to lose on this one over time from a fundamental perspective. And it's just a question of, do I win by them going and buying more assets and then starting a dividend? Do I win by them doing a big buyback? Do I win by them getting bought out at a big premium? Hard to tell, but sort of any way I cut it over time, I should do pretty well on this.
Yeah, it had a similar structure. I can't help but feel there might still be a sell-off. Maybe we see oil come down, maybe the dollar comes back a bit strong, because this might be downside, particularly after what we call a really strong slap in the face there. So I think since oil had the brakes put on, this looks and feels a little bit like a trend-changing event that you might accumulate a bit more, a tad lower first, but long run, what you say sounds fascinating and accurate. I just wonder if this isn't going to be out of their hands and be a little bit of the oil price. We should maybe chart it. A lot of people squeezing in here gives rising wedges. It's usually when you're quite close to a top, everybody suddenly goes, oh, we've not got enough oil and energies. You pop out the top, we call it a type 2, and then you crash quite violently down. That's usually an end of the bull trend moment. And what tends to follow can sometimes be a winding up process to a little bit of a retrace of the initial move. So I think it's recovered immensely. I think it might ease a bit first, just broadly speaking, even if it goes up short term, even if it gets a little bounce. But I think you're hunting in the right area. It sounds like one that shouldn't fall too far. I'm wondering if oil itself will be behind that, though, because on the other one, Joy, there was also a similar structure. I've left the drawings on there, and you can kind of see that part also has that same up and down. Only there's more buoyancy in Joy on the upside than Sandridge at the moment. Just
one of those weird things where Joy actually has debt and Sandridge has net cash. So you would think that Sandridge would behave more like Journey is, but I think it's the power business. I think it's some of the other attributes of that business that are really sort of supporting it. And, my take on Sandridge is, look, it's hated, right? It's still hated even when they flip from having a lot of debt to having a lot of cash, even when they flip from shrinking to growing organically and getting good well results and so on. So, hey, from my perspective, I take a multi-year view on these things, and I like to buy when they're cheap and sell when they're expensive. And I don't like to experience big drawdowns, but if I can hold this thing and it has all this cash and it has this potential to re-rate on the Sandridge side, I'm somewhat indifferent to, hey, does the stock fall a few dollars more before it goes up a lot? Does it fall even more than that and I get an opportunity to buy more? I guess I think from a trading perspective, I see what you're saying. I just don't know that I really can spend the brain power.
Oh yeah, not really criticizing at all. That's just, I'm just giving a technical view. Yeah, the difference is, you might not be able to buy all you want in the first go. Accumulating a position over time can be very prudent. You don't just get to switch it all on. And as you say, you can increase your exposure if it does come off a bit further. I just noticed that you're getting a bit more buoyancy in the recent, there's definitely to Joy a bit more upside joy, can we say, at the moment on a pretty dull oil market, while this is more characteristic of what's happened in oil since March. So it's more proxy at the moment. It's closer proxy to the oil price, while joy seems to have independent strength, if I can put it like that, relative strength. Yeah. Yeah,
That makes sense. And then also, Sarage is much more exposed to natural gas, which has had much more downside than oil. And so I think when you think about it in terms of what it's producing right now and where a lot of its cash flow is coming from, it's more driven by natural gas. So it would make sense that the stock would be weaker. And frankly, the prospects for natural gas, like you were talking about, like there is a good chance the natural gas prices fall more.
And
so
that would see that come up.
Yeah. The flip side is from my perspective, what I'm seeing here that keeps me in it and excited about it is their growth in oil production. And so what I see the potential to, well, one possible scenario could be it actually sells off quite a bit here along with natural gas. And then they come out with their next quarter where they show another 25% growth in their oil production. And people do the math and it's still, let's say, a smaller percentage of their overall revenue, but they see that growth. And at some point, maybe it's this next quarter, maybe it's the quarter after that, it sort of decouples a little. And again, it looks like it's off with oil. I would argue it's more off with natural gas, just given sort of what the economics are for the business. And both oil and natural gas are down a lot since the summer. So they sort of look similar, but I would argue this is more driven by gas, and that the potential here is sort of either they start unlocking value, right? Like they're sitting on all this cash. It's very unusual. Maybe they get a bid if the stock falls enough relative to the cash on their balance sheet and relative to their cash flow. Or over time, maybe the oil production growth leads to them getting less associated with natural gas prices and more associated with oil. But yeah, I think it's really interesting to, this isn't how I spend my time, but it's really interesting to get this perspective. So I appreciate you sharing.
Yes, no, absolutely. And I do feel there will be a little bit of divergence in relative performances. I think gas is going to be far harder hit than oil. I think oil is going to be the relative. So, and you said that yourself fundamentally, and I believe I'm seeing that technically. So we actually concur on quite a lot. And if that one is more exposed maybe to the gas, it'll still be perceived for a while as a gas company until the makeup of the oil component now says, well, it's actually a hybrid of both, and it should be re-rated accordingly. So you might just wait a little longer, but get a bigger kick later. Fascinating. Do you have a third and final shout for us that we can carve up for you?
Sure. I'm actually really curious about your take on this. So it's another one I've talked about publicly, Blackstone Minerals, BSM.
Blackstone Minerals. Interesting. Hey.
They're a royalty company. They own royalties mostly on natural gas.
German or Australian? Listen, or US?
US. B as in boy, S as in Sam, M as in Mary.
Yes, I found it. So it's quite a lot. BLSTF. Is that the one?
No.
Okay, I've got the wrong
Minerals.
Yeah, I've got it as Blackstone Minerals Limited on the OTC US market. Is that the one you're looking for? Or
it's on the New York Stock Exchange, Blackstone Minerals, BSM.
Yeah, let me re-show you this to you, and I'll show you which ones are options. So let's go back to share screen. And these are the options of exchanges that I've got. The only US one is an OTC.
There's a space in between black and stone. That would be.
Oh, got you. All right. Got you. That might make a world of difference. Okay. Got you.
Yes.
Perfect. Thank you.
No problem.
Nice. Can we go out? We'll start from the monthly and just run in, because this is close to, it's been about since 2015 again. Sound right to you?
Yeah, that sounds right. And then just as a caution on this is a master limited partnership. And so there are potential negative tax consequences for non-US investors, and people should be aware of that. To the extent that they are.
So if you are American, you will not face any additional tax than you would over any other equity. If you're a European, you might, or other.
As an American, you might actually experience some benefits, but you would also get a K1. And I'm not supposed to give tax advice, but just as a heads up, it's important to understand what someone might, the stocks trade the same. And then at the end of the year, for some of them, you get a nasty surprise and the rest of them, you're fine. And this is one that you could potentially get a nasty surprise. Actually, I think it's, there are ways to get that exposure that funds do through swaps or through derivatives and that sort of.
Yeah, if you're trading a CFD as a non-US guy, a contract for difference just on the price, I'm pretty sure that it won't be treated any differently because then it's a derivative, isn't it?
Yeah, there are ways. I don't really want to get into specifics, but there are ways to navigate around it.
Sure,
but it is important to just clarify that.
Thank you for that warning. So take tax advice, do whatever, or trade a derivative. If you buy the equity, preferably be American, is our best understanding. Okay.
Yeah.
Tell us the story behind it.
Yeah, sure. So it was a private partnership that family ran with institutional money, and they took it public. I guess it was in 2015. I've only been exposed to this recently. They pay a large distribution, which is their way for this sort of security. It's the way of saying a dividend, and I'm not that interested generally in dividends or distributions. That's not my style or preference. I like value. What happened here is I figured out with the help of I was doing diligence on some other companies and talking to different royalty buyers. So there are people that are employed by companies like Blackstone Minerals, or that do what these guys did before they were public, where they go and buy mineral rights from private owners or from the government or from wherever, or from companies. They'll sell off a overriding royalty interest sometimes. So they'll go and accumulate those either for their own cash flow or to package them and resell them to companies like Blackstone or others. And I was doing research on some other opportunities, and multiple of those private royalty buyers owned Blackstone Minerals in their personal portfolios. And this was very unusual because oil and gas equities generally are very unpopular. And in particular, in the oil and gas industry, many of the private guys look on the public equities with a degree of disdain. They think that they can buy stuff cheaper generally, which is their whole value proposition. So when multiple people owned this and told me about how they owned it personally, that got very interesting for me. And the reason they owned it was that Blackstone Minerals has a giant land position in East Texas that was underdeveloped when it was controlled by BP. And BP has now sold it to a couple of different private owners that are now ramping up their development of that asset. So,
and that's probably following BP's Gulf spill, where they withdrew from America largely in terms of their British petroleum, because they were a bit cynical. They felt that they were treated differently because they were a foreign company. Had it been Texaco or something else, I think I remember when they were divested from all of that. It was around about that time.
Yeah, I think they kept this. And I think they've had this position for a long time, this particular natural gas position. And actually, they have now divested from it, but that was a divestment that they did somewhat recently. And so there's private companies that are ramping up development activity. Blackstone doesn't pay for that development. They just get carried on it as the royalty owner or the mineral owner. And so that hasn't come into their cash flows yet, at least not materially. And what I saw was a business that was undervalued because they cut their distributions in the downturn. Frankly, they made some strategic errors. They sold assets at a bad time, and then they bought lower quality assets at a higher price later. And, just generally strategically, it's not the sort of thing I generally like. But what I liked about this was they were at a big discount because of that. Over time, they were set up to be able to double their distribution. It's already 10% or so from a yield perspective. So they could fundamentally double it just from their existing cash flows. And then they had this big asset that was just starting to get developed, which could over time be worth more than the entirety of their business. And so that was what that due diligence led to. I got interested in it again. Like, this wasn't something that I was focused on, and it just was so overwhelming in terms of the value of that asset. Even at low natural gas prices, it's still worth a lot of money. And over a multi-year period, natural gas should, after wherever it falls to, it should recover as liquefied natural gas export facilities are built in the US and as there's a call on additional natural gas in the US. And so they have this asset that's super valuable. They have a yield that's sustainable at much lower commodity prices. And it just I didn't see people really talking about it. The company was sort of sandbagging it, and that offered a really significant potential. And I think I first talked about it this summer, and it's interesting because it's still over where it was at a time where oil and gas stocks have now fallen, especially on the smaller cap side, pretty materially from where they were, let's say, in the June timeframe. So they did fall a little, but they've actually held in there, and it's sort of worked in terms of outperforming XOP or PSCE since I've gone into it. And since I've talked about it,
not to check it out, Western East Texas way, is that a gas based or a oil based option?
It is natural gas. Natural gas. Yeah. And again, I prefer oil, but if I can get a gas asset worth potentially billions of dollars for free in a business that produces oil and natural gas and pays a large dividend, a distribution, again, like I'm not averse to that.
Yes. I'm just seeing, I just did divided in by the WTI price just to see, because it appeared to me they've been overperforming recently. They might have been disproportionately hit at some point, but if we split the screen and we put WTI on there, which is just put the base case of Texas oil, seeing as we're especially down Texas way, they seem to have done better recently. They've held on better. So daily. So oil hit its highs. Let's try to get these dates aligned up underneath each other. And I think it becomes more apparent. June, that's a week. Hold on. So we better make this one a week as well. Yeah, that COVID is such a go back to regular scale for that. 2020 and June. Yeah, just lining those charts up. Sorry for the slight delay.
No worries.
But just highlight.
There is material outperformance.
Yes, recently, because you kind of topped March, as we said, and that was over here. So during the period that oil made its high here, you were over here, but in actual fact, you've continued to channel upward broadly there in a period that oil has gone down. So that points to a re-rating clearly going on in perception there that's already begun. So whilst you're early, you're probably not the only one that's starting to recognize that. It's fascinating.
Yeah, I think so. I think it's becoming better known, and it's sort of one of these setups where as it becomes sort of unknown to a little known to starting to generate cash flow to allowing them to increase their dividend or distribution, that's sort of the potential for sort of a full re-rate. One other interesting thing about these guys, and it's similar for certain other producers, they have very low priced hedges. And so that offers a lot of upside from two different perspectives. So one, they're less likely to get hurt if oil and gas prices are to fall fundamentally, because they're already making less money on average in the periods where they've essentially pre-sold or locked in their price at these lower than current prices. So that's one way. The other way is that as prices stay healthy or rise, you can see their cash flow actually increase, and then their ability to pay off debt and then increase their distributions rise as well. So it's set up that was what I was alluding to in hey, they're paying a 10% yield and they could potentially pay closer to 20. As those hedges roll off, their cash flow increases, and with their structure, they're set up to increase their distribution after some amount of debt pay down with higher cash flows.
Got you. So they didn't trade very well, basically. They locked in prices too early. They didn't, but that's priced in now. And now that you get the opportunity of an upside where they're going to get a second shot at it
Yeah,
at better levels than they originally secured.
exactly.
Got you. Yeah, that's cool. That's clear. And the overperformance is quite stark. In fact, since 2022, really, apart from the blow off, maybe March, if you want to say from March, the high, it's been quite stark. So that's a very interesting point. Are they similar to the precious metal royalties companies in essence? So have they provided capital and secured a certain level of flow, or is this a different business model? Is my was when I hear royalty company, I'm thinking of the gold and the silver royalty guys, or is this a different? Am I getting it mixed up? There's some other dynamic.
So it's a similar idea, but not the same. So typically, those royalties are financing arrangements, and generally, these royalties are more. I mean, it ends up functioning similar, where they get a percentage of revenue, and in many cases, without substantial costs attributed it to, so their margins are ultra high. But there are differences in terms of the origination. So typically, for lease that Blackstone owns the minerals on, they either owned the land, the mineral rights to the land, and then leased it out, and were guaranteed a portion of the revenue in exchange for allowing the producer to drill on their land, or they bought the minerals after that lease had already taken place, and there was already an arrangement between the producer and the prior owner of those mineral rights. So sort of in either of those cases, that's sort of how it's set up. There are occasionally royalties that originate with the financing of development in oil and gas, but those are more rare. But functionally, these are very similar to the metals royalties. It's just that the origins are different.
Yeah, so habitually it's more because they were the original owners, but they didn't want to get involved operationally, or as you mentioned, it was already now an up and going operation, and then they bought in a certain element.
Yeah, exactly. And obviously, what you can see is that the metals royalties companies typically hold up better in downturns, and Blackstone Minerals did not. And they had almost no hedging in place. They had a little too much debt. So, their unit price did very, very poorly in COVID and during that crash. And I think one of the interesting things is they were then very reactionary. They put on these hedges that locked in low prices after, which I don't like, and the asset transactions were poor, which I also don't like. But those are to a large extent in the rearview mirror, and as they sort of heal out of that, there's the potential for them to outperform. This is not likely to be something that I own for a long time, partly because of those strategic errors. When I look at what they did versus what Journey and Sandridge and others that I like, and I'm going to probably own for a long time, did, the mechanism of navigating through the downturns were really different. And I just feel more comfortable, even though the share price performance was sort of similar for these companies in the crash. I feel more comfortable with the way that the others navigated through the downturn, and they've done a better job of preserving value when things were bad and creating value as things recovered. Blackstone was not the same. That being said, again, Blackstone sort of, through prior efforts, acquisitions they did in 2017 and in that time frame, they got into this position where now years later, these assets are turning into value well beyond what they could have anticipated. So
And there are credit for that. They were investing.
Absolutely.
And they continued to build assets. So I think maybe, nobody saw the scale of COVID coming. And then the natural reaction on any recovery is to snatch the first number. It's a trader's mistake who's held on to a bad trade that's gone horribly wrong. And then the first time he gets a bump, he gets out because he thought, I don't want to repeat the previous message. It's again, that's what we were saying, that recency bias. They thought, well, damn, we had no hedges. Now they overhedged too soon in the aftermath. I think I can understand that. I wouldn't necessarily say the entire management is bad on account of that. And the fact that they were making positive investments that are now coming to fruition maybe it's it's a sin on the hedging that you can forgive them for, providing that on the basis that they'll be smarter next time, hopefully.
Yeah, but again, I think from my perspective, I'd rather own the top sort of 1% of teams and sort of be aligned towards that. And in this case, it's less. I think, like you said, they're not bad, but they didn't navigate through it in sort of as good of a manner over multiple different criteria: asset transactions, price hedging, debt coming into it, and so on. And so I think it's possible to benefit in this case from the re-rating associated with the likely increase in their distributions, as well as through the unlocking of value on this asset that was very poorly understood when I got into it and is still not well understood and not yet contributing to those distributions. As that happens, I would look to exit this and redeploy into companies that I want to hold where I think I'm more aligned from a longer term perspective.
Yeah. So I get the feeling you're more confident on the management teams on the previous two, and then this is more just a case of it's got upside value due to possibly some bad management decisions and some decent investments made before all the volatility eventually being realized now, and that timing is now. So this is more of a timing one, while the others you'd probably be happier to hold longer term.
That's right.
Yeah, awesome. Josh, that's been phenomenally interesting, and you've got some really great knowledge and some great narratives. And I want to say thank you to you for sharing that with me and all the viewers. And I'd like to give you the opportunity to just tell all the guys. There's a couple that we're bison bullish on. How do guys find you, and how do they engage with you should they wish to invest in your fund?
Sure. So none of this is a solicitation, but it's possible to find us. Bisoninterests.com is our website. There's a contact us if you're interested in reaching out. And then we're active on Twitter as well. At Bison Interests is a good place to find us on Twitter.
Right. And we'll drop those links below for people that'd like to find more. If you're feeling strong on energy, and I do think it'll have a role, I think it won't be a simple year, but I still think it's going to be, I'm in a hyper-stagflationary macroeconomic environment. And that points to physical things and commodities being stubbornly strong in spite of my fear for demand-based events to the downside. I think these will be sticky strong and they will rebound harder and faster. So I quite like, and I have gone lots off energies anyway, particularly the oil side. And I think Josh made that point very well. Great. So click the link below to engage further with Josh. And thank you very much for coming on. I've really enjoyed this.
Yeah, thank you very much. I really appreciate it.
All the best to you.
Okay, thank you. You too. Take care.